They changed the rules in the middle of the night because you were winning. While silver broke through $75 and traders celebrated their positions, the exchange operators made a phone call that would rob thousands of investors by morning. This wasn't a market correction. This was a coordinated attack. At 3 a.m., buried in a website update that no mainstream outlet reported, they deployed the same playbook used to crush the Hunt brothers in 1980. But this time, something is different. This time, the fundamentals cannot be manipulated away. What you're about to hear is the anatomy of the greatest theft in modern commodity markets and why their desperate measures prove we're closer to victory than ever before. The weapon they deployed is called a margin requirement hike, and it's designed to force you out of winning positions without the market moving against you. When you trade futures contracts, you're required to maintain a certain amount of cash as collateral. This margin acts as insurance for the exchange. Under normal circumstances, this number changes gradually based on volatility. But what happened Monday night was not normal. They doubled the requirement overnight. Imagine holding a contract that required $10,000 in margin yesterday and waking up to a notification demanding $20,000 by noon today. You didn't lose money on the trade. The price didn't crash. They simply rewrote the contract after you signed it. Thousands of traders who were positioned perfectly, who read the market correctly, who deserved to profit from silver's rise, were hit with forced liquidation notices. They had to sell their positions not because they were wrong, but because the exchange moved the goalposts. This creates artificial selling pressure exactly when the banks need it most. It's not a free market mechanism. It's financial warfare disguised as risk management. The margin hikes weren't enough to stop the momentum, so they escalated to the next level of manipulation, disabling the buy button. We've seen this before. When GameStop was squeezing the hedge funds in early 2021, Robinhood and other brokers suddenly restricted purchasing. They claimed it was for your protection, for risk management, for regulatory compliance. It was a lie then, and it's a lie now. Multiple brokerage platforms are reporting that traders attempting to purchase new silver contracts are receiving error messages. The systems claim risk limits have been reached or that trading is restricted to liquidation only. Read that phrase again, liquidation only. You are permitted to sell your silver to the banks at whatever price they're offering, but you cannot buy more from them. This is economic censorship. When you remove the ability for buyers to enter the market while sellers can still exit, you create a one-way price mechanism. It can only go down. This isn't a technical glitch. This is a coordinated effort across multiple platforms to artificially suppress demand and allow the short sellers to cover their positions at favorable prices without facing the natural buying pressure their corruption created. While restricting real buyers, the banks unleashed their algorithms to create the illusion of massive selling pressure through a tactic called spoofing. This morning, enormous sell orders appeared on the COMEX order book, 5 million-ounce blocks listed at $76. To a retail trader watching the screen, this looks like panic. It looks like the smart money is getting out. It triggers fear. But here's what's really happening. These orders are never intended to execute. Milliseconds before the price reaches that level, the orders vanish. They're canceled automatically by high-frequency trading algorithms. The banks never had any intention of selling 5 million ounces. They simply wanted to plant the idea in your mind that massive supply was hitting the market. This psychological warfare makes traders second-guess their positions. It creates the false impression of bearish sentiment. Spoofing has been illegal for years. JP Morgan was fined nearly $1 billion for this exact practice in gold and silver markets. Yet here they are, doing it again in broad daylight, because they know the regulators won't stop them when the entire banking system's solvency is at stake. The reason they can commit these crimes so openly is because the COMEX itself is compromised. The exchange is supposed to act as a neutral referee, ensuring fair markets for all participants. But the COMEX is owned and operated by the very institutions it's meant to regulate. Board members are former executives from JP Morgan, Goldman Sachs, and other bullion banks. When they vote to change margin requirements or halt trading, they're not protecting market integrity. They're protecting their former colleagues' balance sheets. This is the ultimate conflict of interest. Imagine a football game where one team's owner is also the referee, and halfway through the game, while his team is losing, he declares that touchdowns now count for 0 points. That's what we're witnessing. The COMEX has sacrificed whatever credibility it had left to prevent a handful of banks from facing the consequences of their reckless short positions. They've proven beyond doubt that the paper futures market isn't about price discovery or hedging. It's a rigged casino where the house changes the rules whenever the players start winning too much. The clearest proof of manipulation is the widening gap between paper prices and physical reality. While the COMEX futures price is being hammered down through margin hikes and trading restrictions, the real-world cost of obtaining actual metal tells a completely different story. Dealers selling physical 100-ounce silver bars are charging premiums of 40 to 50% above the spot price. This isn't normal. In a functioning market, the premium should be 2 to 5% to cover minting and delivery costs. A 50% premium means the paper price is completely detached from physical supply and demand. It means the spot price displayed on your screen is fiction. It's a number agreed upon by banks who are trading contracts they have no intention of delivering. Meanwhile, if you want silver in your hand, in your vault, under your control, you have to pay the real price. This bifurcation proves that the COMEX has become irrelevant for actual price discovery. The banks can manipulate the digital number to whatever level they want, but they cannot conjure physical metal into existence. The market is splitting into two realities: the banker's fake price and the people's real price. If the current manipulation tactics fail to crush the price, the exchange has a nuclear option hidden in the fine print: force majeure. Buried deep in the futures contract terms is a clause allowing the exchange to declare an emergency and void its delivery obligations. If silver continues rising despite their cheating, they will likely invoke this clause. They'll claim that extraordinary circumstances have made delivery impossible. They'll offer you a cash settlement based on yesterday's manipulated price, not today's real price, and certainly not tomorrow's higher price. This converts your property right into a paper claim at their discretion. It's legalized theft. They're pre-writing the rules for their own default. The reason is simple. The vaults are nearly empty. The gold and silver held in COMEX warehouses has been declining for years. Much of what's listed as available for delivery is already encumbered by multiple claims. When the run on the bank begins, when enough contract holders demand physical delivery simultaneously, the exchange will not be able to fulfill its obligations. Force majeure gives them a legal escape hatch to avoid bankruptcy while leaving you holding worthless paper. While all this manipulation unfolds, the mainstream financial media maintains total silence. Turn on CNBC, Bloomberg, or read the Wall Street Journal, and you'll find virtually no coverage of the margin hikes, trading restrictions, or physical shortages. Instead, you'll find hit pieces dismissing silver as a meme stock or warning of a dangerous bubble about to burst. This coordinated blackout isn't accidental. The major banks are among the largest advertisers on these networks. They fund the journalism that's supposed to hold them accountable. The result is narrative control. They want the public to believe the price drop is natural market action, not engineered manipulation. They want you to think smart money is selling when the opposite is true. By controlling the information flow, they're trying to prevent the retail panic buying that would accelerate their demise. The silence is as much a part of the manipulation as the spoofing and margin hikes. The most dangerous aspect for the Western financial system is that not everyone plays by American rules. China is watching this manipulation closely, and they're responding by accelerating their physical accumulation. The Shanghai Gold Exchange operates outside COMEX jurisdiction. When Western banks artificially suppress prices, China sees it as a gift. They're using the fake low prices to drain physical metal from Western vaults at a discount. The Chinese government actively encourages its citizens to buy gold and silver as savings vehicles. They're building strategic reserves while America plays with paper contracts. This represents a massive geopolitical transfer of wealth and power. The very manipulation designed to save American banks is simultaneously handing the keys to the future global economy to the East. Every ounce that moves from New York and London to Shanghai and Beijing is an ounce the West can never get back. The banks are selling their strategic birthright for short-term survival. They want you to believe their power is absolute, that they control the price through sheer force of will. But read their actions, not their words. The frantic rule changes, the desperate margin hikes, the spoofing, the trading halts. These are not the moves of an entity in control. These are the thrashing movements of a cornered animal that knows the end is near. A strong player doesn't need to cheat to win. The fact that they're cheating so openly, so desperately, is the ultimate confirmation that they've lost control of the fundamentals. They can delay the inevitable. They can rig the paper price. They can change the rules. But they cannot print geology. They cannot create silver that doesn't exist. The supply deficit is real. The industrial demand is accelerating. The vaults are emptying. Every ounce of physical metal you hold is an ounce they cannot use to cover their shorts. They need you to sell. They need you to give up. That's why they're cheating. Don't give them what they need. The volatility is the price of admission. The manipulation is the proof you're winning. Hold the line. Need Scheiß 2.